Welcome to Daily Tax Minute. This is Tony Novak here to share a few points on saving taxes and staying out of tax trouble. Let's jump right in. Today's topic is year-end tax shelters. Now, here we are towards the end of October, and I'm talking about year-end already. The point is that for tax deals, tax strategies that take some time to implement, and when we are approaching the holidays and business comes to a grinding halt, we're counting down the days that are actually productive to get things done. I know I've been doing this decades now, and it may seem like there's plenty of time, but there's really not for clients that really want to get uh, things done and save a substantial amount of tax. So let's talk about year-end tax shelters. What is a year-end tax shelter? Basically, it's a strategy, it's a deal, it's a investment of some type. It's a transaction where we put in or engage for a certain amount of money, and the transaction gives us back uh, almost that much, the same amount, or even more than we invested in tax deductions and sometimes tax credits. Let's break that down a little bit. So the most common way is well, first of all, let's go in the order I presented them. The type of year-end tax shelter that will give you back most of what you put in. The most common example is investment in real estate. With accelerated depreciation, you can, if you put a certain amount down and you borrow more, you're going to get a good chunk, more than your down payment, not quite as much as you borrowed in total, but you're going to get a substantial amount of that as a deduction on your income tax right away this year, particularly I don't want to get sidetracked, but on short-term rentals where it's treated by like an active business, you can actually take a little bit of a loss against other income, W-2 or otherwise. So that's the first one. The second most common, which is I said, you deduct all of what you contract for or contribute. That's the best example is a qualified retirement plan. So we know them as 401ks, pensions, IRAs, SEPs, simple plans, any of those. Uh, if I have a higher than average expected income this year, and I want to set aside a certain portion and put it into one of these plans that immediately comes off of my income and is not tax deductible, or is not taxable, becomes a tax deductible item. So in that case, my own specialty happens to be private business pension plans and annuity plans that are a little bit cheaper to operate. But in any event, when you're trying to do something more than what the average SEP or 401k or money purchase plan, profit sharing plan will allow, we can set up a private pension plan, which essentially amplifies the potential tax benefit. But again, we can't wait until the last minute. We have to start that pretty early. And the third category is the type that gives the opportunity where you put in $1 and you get more than $1 back in tax benefits. And that's where the traditional tax shelter comes in. It's typically talking about a active business of some type, and often combines tax deductions with leverage. In other words, you're borrowing or you're on the hook for some additional amount besides what you put in, and then also often some tax credits. Now, my specialty or what I'm working on lately happens to be docks, boat docks, marina boat docks. So it's like rental real estate, except the cash flow is a little better and the write-offs are a little faster. So it turns out to be a little bit better from a tax point of view and a cash flow point of view than investment residential real estate. So those are three types of tax deductions. I would love to hear your thoughts, comments, feedback. If you're in that type of situation, I'm easy to reach on social media, or it's the kind of thing you want to talk one-on-one. It's no obligation to do that. I'm easy to reach at taxproblems.cpa. I'll be back tomorrow with another Tax Minute.